Unit 1, project finance. So project finance basically is a specialized method of funding large-scale capital-intensive infrastructure or industrial projects. So unlike traditional corporate finance, here lenders in project finance will focus primarily on future cash flows of a project repayment rather than looking at the credit worth or assets of a project sponsor. So the core feature when we're dealing with project finance is special purpose vehicle, which we call SPU, SPV. So this is a separate legal entity established mainly for executing and operating a project. So we have what we call the SPV, which isolates a project's risks and obligations from the sponsor's corporate finances. So this model is commonly used when we're dealing with power generation projects like hydro or thermal, and dealing with transportation infrastructure of toll gates, airports, oil and gas development, water treatment, sanitation, telecommunication networks. Now let's look at the historical context and adoption of project finance in developing countries. So during the 1980s and 1990s, many developing countries struggled so much with the limited financing and growing infrastructure needs. So with these needs that kept on growing, there was an increased budget deficit that gave pressure to private state-owned enterprises, and they needed to sort alternative financing. So project finance now emerged as a solution that established number one, attraction of FDI, which offered bankable projects through what are called the SPVs and takeoff agreements. Number two, they embarked on the reduction of the sovereign debt burden. Okay, they embarked on the reduction of the sovereign debt burden, which means the since more project finance deals off balance sheet and non-recourse, they did not add to government debt. Then thirdly, the project finance made as a solution that embedded the risk transfer through the construction, the operational, the market risks that are highly shifted to the private sector partners via contracts, and also promotion of PPPs. So these were the partnerships that allowed government to share project ownership, performance risks, and return with private entities. Now, with multilateral institutions like the World Bank, the IMF, the IFC, which is a International Finance Corporation, these played a very critical role because they provided political risk guarantees. They also provided for financing and de-risking projects, and also established the global norms for PPPs and project financing structures. So in this course, we are going to look at key terminologies that will help us understand. When we say SPV, we're looking at the special purpose vehicle, which is an independent company that is formed to carry out a project. So it will own the project assets, it will sign contracts, and it will be the actual borrowing entity. We're also going to look at terms like non-recourse financing. Non-recourse financing is where lenders can only claim repayment for the project's cash flows, not from the personal or from the corporate assets of the sponsors. Then we'll look at terms like takeoff agreement, which is simply a legally binding long-term sales contract. Okay. So these are the key terms that we'll be looking at. Then we'll also
Yeah. So,
limited resource financing. So I'm muted. Limited resource financing is simply a hybrid non-recourse and corporate finance where lenders have traditional or conditional access to sponsor support. The concession agreement is simply a legal contract that will give the SPV the right to build and operate facility for a defined period of time. So the key players that we're going to look at in project finance will be sponsors. These are the project initiators. It can be corporations, joint ventures, governments. These are people who provide the initial equity and the strategic direction. So we're also going to look at lenders. These could be banks, the development finance institutions, the export agencies, the bondholders. Then we have the off-takers. These are buyers of the project's output, like national utilities or commercial clients. We're also going to look at the EPC contractors. These are people who handle the engineering, the procurement, the construction of the projects on a fixed price basis. O&M contractors, these ones are the people who manage the daily operations and maintenance post-construction. So O&M is simply operations and maintenance contractors. Then we're also going to look at the government entities. These are involved in permitting or licensing or policy land acquisition. We're also going to look at the advisors. These are the legal, the technical, the financial advisors who are key in doing due diligence. Okay. So
Corinne, maybe before you move, sorry.
yes, please.
There were saying sponsors and there's that invest equity. So why are we saying they are sponsors and yet maybe the finances will come from the lenders? Maybe just try to highlight on the sponsor being they will invest in equity and the people that will be providing funds are different.
Okay, that's a good question. The question is, what's the difference between sponsors and lenders in that context? How do we differentiate the sponsors and lenders?
Of course, from the layman's language, when we hear the sponsors, what comes in the mind is they will also provide the funds.
Yeah. So the differences come in their role and their objective and the type of financing that they have and the exposure of risk that is involved in there. So when you're dealing with sponsors, these are project initiators. They'll provide equity. They also provide strategic direction, whereas lenders are just institutions that will provide you debt financing. They don't care. Then the primary objective that sponsors may have is mainly long-term, okay, through project success and ownership. They want the project to go through. But the lenders, their interest mainly is their money to be paid back and their interest. And the type of financing that comes from sponsors is equity. It's got a risk at capital, whereas the financing that comes from lenders is debt. It can be secured or an unsecured loan. Then the risk exposure that sponsors have is high, whereas lenders is moderate because it's protected by collateral. And the involvement for the lenders is mainly active, meaning they're involved in the project planning, they're involved in decision making, whereas lenders, it's passive, mainly they're concerned to make sure that they mitigate risks, their money has to come back. All right. And sponsors, they get their returns through dividends and capital gains. These lenders will get their interests or returns through what? Through interest rate repayments. So the examples of sponsors we could have corporations, joint ventures, governments, private equity investors, whereas lenders are commercial banks. All right. It's a very good question. I hope it clarifies.
Okay, yes, it does. So maybe in an example of the dual carriageway, Ndora dual carriageway.
Yeah.
So when we say the government is a sponsor and they have put equity, so maybe if I may try to understand it from that point, what type of equity has the government provided in that project?
Okay. So the question is, in the dual carriageway, we have both lenders and sponsors. First of all, who are the lenders in our the dual carriageway that we have, and who are the sponsors? Let's identify them.
Whether the sponsors is the government, then the lenders, is it not NAPSA? NAPSA.
Yes. Are we getting that practical example? Who are the lenders and who are the sponsors. So when you look at this one, the sponsors are government, because they're the ones who initiated the project under the PPP model. It's a 5-year contract. Okay. We also have our not only government. Government is not only the only sponsor. We also have the Macro Ocean Investment Consortium. Okay. These ones comprises of AVIC, okay, the China, they're responsible for the design, the construction, so they're also under the category of sponsors. Then when talking about lenders, we have NAPSA, which has provided the facility loan, which is approximately 46% of this project. We also have workers' compensation. They've also contributed a certain amount towards this project. We also have the Bank of China, Stanbic. These are all under categories of what? Of lender. So the rationale is that the sponsors, the government here is aiming to enhance the infrastructure, which will boost what? Economic growth. The interested party, okay, in improving connectivity between these two regions. All right. Whereas NAPSA, the workers' compensation, these institutions are investing in national infrastructure with the aim of generating a return for their members whilst contributing to national development. So their aim basically is to ensure that they get a return from that. So there are different roles in there. The Bank of China, the Stanbic Bank, the involvement just to administer additional financial support that will leverage them in getting financial viability. So it's a collaborative approach where we have these who are playing their role. Is that clear?
Yes, yes.
All right. Okay, so now want to look at a project finance and corporate finance, the differences and also the context. So when we are looking at corporate and project finance, these ones differ in terms of their structure, in terms of their risk allocation and repayment mechanisms. So corporate finance is basically based on looking at the financial strength of the entire company. So here lenders want to assess their overall balance sheet, including the balance of liabilities and assets. So here financing is raised on the creditworthiness of the corporation, and also repayment is sourced from the company's total income. So this is one of the most common methods that is used for established firms with stable cash flows. Whereas project finance is different in that it is centered on financial viability of a specific project. So that's why we have a special purpose vehicle, which is often created to isolate project from the sponsor's corporate balance sheet. So this financing basically solely is expected to look at these distinctions. So the distinctions between the two, corporate finance and project finance, is on terms of security, risk sharing, recourse, and transparency. So these are the main differences. So if we're going to look at the difference in terms of security, corporate finance looks at the entire company's assets and cash flows, whereas project finance looks at the project's assets and the future cash flows only. In terms of risk, corporate finance, the risks are borne mainly by the company. Project finance, the risks are allocated among the parties via contracts. Okay, so let's look at the structure of project finance. Structure of project finance. Now, project finance basically is designed to ensure that there's long-term sustainability and effective risk management. So the major components include equity contributions. It includes debt financing, risk allocation, security package. So the equity contributions here includes sponsors. For instance, the private investors, government, will provide a certain portion of the required capital in form of equity. So this capital is at a risk, and it demonstrates the sponsor's commitment. And the returns to this equity will depend on the success of the project. So we also have debt financing. Debt financing, the remaining capital is raised through long-term debt. You cannot always pump in money uh, from equity. You need to balance up the basket. So this money will come from commercial banks, development institutions. Like we're going to give this example of the dual carriageway. Equity is coming from government. The debt finance is coming from Stanbic Bank, the Bank of China. Okay, so these loans are secured with long-term tenures, maybe 15 to 30 years, and aligned with the project's cash flow generation, like the monies from the tolls. We also have the part of the structure, a risk allocation. So the expected risks that we expect. So this is a core principle in project finance of assigning risks to parties to best able to manage them. For instance, the risks can be segmented into construction risk, which is allocated to an engineering company like AVIC. The demand risk can be mitigated through long-term takeoff agreement. And political risk can be covered by guarantees or political risk insurance. So risk allocation is formalized through contracts such as the EPC agreement or power purchase agreements, the PPAs or concession agreements. So in this case where the UPND has made a contract, what happens if a new government comes in? There are certain contracts that should secure a project from not being influenced by governments. Then we also have a security package where lenders will require a comprehensive security arrangement to safeguard their investments, which may include maybe pledge of project assets like land, plant, and equipment, or assignment of key contracts such as EPC, O&M, and offtake agreements. And also the escrow accounts, which could be used to control project revenues and ensure that there's timely debt servicing. And also steps in right, allowing lenders to take control in case of a default. Now, there are certain stages that we must take note of that are involved in a project finance deal. So, by the way, we need to understand these questions by the time we're done with this lecture. We must explain the events that led to most of the developing countries, briefly present an outline of the distinction between project financing and corporate financing, which I've talked about, describe the 5 distinctive features of project finance deal, who are sponsors of a project finance deal, and list the categories of project finance deal. Okay, need to explain the key terms, what is SPV, what is takeover agreement. So this is what I'm teaching you to understand in a lecture. List, explain advantages and benefits of project finance to a host country, and explain benefits of project finance over corporate finance, and explain any 6 disadvantages of project finance. So let's think in those lines, because this will be your homework. I want it to come from your understanding from the lecture. Are we together?
Yes.
All right. So these questions might be repeated in your test or in the exam. So let's be attentive. So we are now looking at the stages that are involved in a project finance deal. So there are several stages that are involved in a project finance deal. So a project finance transaction typically progresses through several structured phases. Number 1, development phase. So this is the planning and preparation phase where the groundwork is laid. So we are conducting feasibility studies. They can be technical, financial, environmental. You also secure the regulatory approvals and payments and develop project financial models, the risk assessments, and initial cost estimates, and identify the stakeholders and forming consortia. The second step is financing stage. Here we are going to focus on raising what? Finance or capital by negotiating and securing equity investment from sponsors or institutional investors. We also arrange debt financing from the banks, the DFIs, and the capital markets. And also you need to draft the legal documents using loan agreements, shareholder agreements, security documents, and also financial disclosure is achieved when agreements are all signed, then funds become available. The third stage is the construction phase. In this phase, the project moves into physical execution. So you're going to appoint and mobilize the EPC contractors. So I talked about these terms in the preamble. So then you're going to implement the strict project management, which will include timeliness and quality control. You're going to monitor the costs. You're going to monitor the risks and milestones as the construction progresses. Then the lender may disperse funds in tranches tied to performance and compliance. Then after the construction phase, the project transitions into the operational phase where it begins generating revenues to service the debt, and followed by decommissioning or asset transfer at the end of the project line. So are we together? Yeah, on the stages. Let's go through the stages again involved in a project finance deal. Stages that are involved are very important to master. So these stages are critical to ensuring that the project is successful from the initial to the transfer. The first stage is the development stage. This is the foundation of the entire project. So feasibility studies are conducted where you're going to assess the technical, the financial, economic viability, which includes also demand forecasting. That's why you need to learn regression analysis. It also includes environment impact assessment and social impact assessment. You also look at the regulatory approvals and permits where you need to acquire the legal rights, land access. That's where government comes in. You also need to conduct project design and planning. So you have to have preliminary engineers who have project scope definition and output specifications. We have financial modeling where we're going to estimate costs and revenues and return on the investment. There is the risk identification and mitigation, where we're going to have preliminary identification of risk and how they'll be allocated and mitigated. The second stage is the financing stage. This is where project is proven viable. So capital must be secured either from equity or debt. So you raise equity from the sponsors or institutional investors who provide what? Finances through capital. You also secure debt which will come from lenders like commercial banks and DFIs. And also financial disclosure, you need to sign loan agreements and disbursement terms. So at what stage do we disperse the second amount? Then risk allocation agreements where you finalize key contracts, okay, and concessions. Then also credit enhancements, where which may include guarantees and political insurance and letters of credit. Then the third stage you said is what? Construction phase. What did I say is involved in the construction phase?
So you said that's why you have the execution of the contracts done by the EPC. So that's when the work will start.
That's when the work starts, yes. So the EPC contract execution, you have the engineering, the procurement, the construction, and contractors carry out the project works. Then disbursement of funds through debt and equity is injected as per construction milestones. Then we have monitoring and compliance. So we're going to have an oversight from an independent engineers and financial auditors to ensure that there's adherence to timelines and the budget and quality standards. And there's also contingency management, which includes adjustments that are made to handle cost overruns, delays, or unforeseen issues. All right. Then we have the operation phase. What happens in the operation phase? In this operation phase, once the construction is completed and the facility is commissioned, we have revenue generation. So the project starts generating income from the users from tolls or electricity sales. Okay. Then debt servicing, where cash flows now are used to repay the interest and the principal of the lenders. Then O&M activities, where operations and maintenance contracts will ensure that the project remains functional and efficient. Then performance and monitoring. So you have ongoing review to ensure that there's technical and financial performance standards that will meet the agreed targets. And dividend distribution, where the surplus is distributed to equity holders. Remember, we have government who's an equity holder. They'll get their money through dividends. Then the final stage is decommissioning. So at the end of the project line, several outcomes are possible. Number one, decommissioning. So the facility is now dismantled and environmental and safety protocols should be followed. Then transfer to government, okay, for a BOT. A BOT is a build, operate, transfer. BOOT, build, own, operate, transfer. So these models are implemented where the asset is handed over to the public authority as agreed standards. Then asset sale and renewal. So in some cases, the project can be sold or concession can be renewed based on performance and policy. So these are the stages that are involved. I hope this is clear. Then we look at investment types in project finance. What types of investment types do we have in project finance? So project finance has a mix of financial instruments that are tailored to a project's risk profile. So we have equity investments. These are provided by sponsors like private firms, governments, or strategic investors. Their role is that of ownership of the project. So it carries the highest risk, but also potential highest returns. And the mechanism is that the dividends and capital gains, what they get the returns from. So it's important because equity will cushion lenders from losses and also shows the sponsors' commitment. The other types of investments are debt instruments. These are fixed term loans with a fixed repayment with interest, typically long term. We also have syndicated loans where we have multiple bank pools resources to reduce what? Individual risk exposure. We have bonds, project bonds that are issued to investors and are repaid through project revenue. And these can be backed by guarantees. Then we have what we call mezzanine finance. This is a hybrid kind of equity and debt. Typically, it is subordinated to senior debt, but it's senior to equity. So it carries a high interest due to its elevated risk, but can also include equity conversion options. You can convert from debt to equity. So it's useful for projects with cash flow uncertainty or high capital needs. Then we have grants and subsidies. These are mainly offered by government or multilateral institutions or donors. The purpose mainly is to make a social benefit to the community through water, health, education, infrastructure. So it's financially viable. There's no payment required, don't require any repayment. This will reduce costs of the project. It's often tied to performance metrics and policy objectives. Okay, so these are the types of finance. So let's look at the advantages and disadvantages of what? Project finance, and also the benefits that the host country may have. Then we go to the review questions. So what are the advantages of project finance? There are several advantages that project finance may have. So project finance will offer strategic financial and operational benefits. These will range from large scale to capital intensive projects. So number one, it limits exposure to sponsors' core business. So project finance is an off-balance sheet, meaning the project's debt, the project's risks, they do not directly affect the parent company's balance sheet. So here sponsors are protected from specific project liabilities. So it isolates their core business from potential financial setbacks. Secondly, it enables large-scale investments without overburdening the sponsor's balance sheet. So by relying on project-specific cash flows, a company can undertake massive investments, e.g. road, power plants, hospitals, without excessive borrowing or diluting the shareholders' equity. So this will allow sponsors to pursue capital-intensive ventures whilst maintaining financial health in primary business. The other advantage is that it attracts international what? Capital. Project finance attracts international capital. An advantage So a well-structured project will draw funding from foreign banks, international investors, multilateral lenders like the World Bank, and also uh, export credit agencies. So international capital thereby bring not only funding, but discipline and transparency and credibility to the project. The other advantages of project finance is that it facilitates risk sharing among multiple parties. So risks such as construction delays, price volatility, demand fluctuations, all are allocated through these contractual agreements that we've talked about, like the EPC, O&M, and PPA. So this allocation ensures that the risks are borne by the parties involved. Okay, so this will actually improve the overall performance of the project. So we go to the other advantages of boosting infrastructure development in underdeveloped areas. So project finance will enable development of infrastructure in geographically or economically marginalized regions where governments may lack resources. So examples could be REA, it's Rural Electrification Agency, REA, yeah. So, and water projects. This will enhance macro. Um, any questions so far?
No, everything's clear. Thank you.
Okay, so if everything is clear, we'll go to the disadvantages. The disadvantages of project finance. So despite many projects, project finance may have its own challenges, which must carefully be managed, especially in emerging markets. So some of the disadvantages are there are high transaction costs due to the complex structuring. So arranging a project finance deal requires numerous legal, financial, and technical environmental advisors. So this will increase what? To increase costs. Number two, longer time for financial exposure. So financial exposure can actually take 12 to 36 months. So this will involve negotiation, regulation compliance, investor engagement. So this delays project startup and also adds opportunity costs for sponsors and governments. The other disadvantage is that there's heavy documentation that is required. So contracts must highly be detailed, covering all possible scenarios, um, like force majeure. You know what force majeure is? Arbitration, default procedures, legal and financial documentation, which include loan agreements, security arrangements, guarantees, and feasibility studies. Another disadvantage is that there's political and regulatory risks in developing countries. So changes in government and policy, instability or regulation unpredictability can jeopardize projects' returns. So political risk can um, and currency convertibility can also be a high risk. Then also difficult in renegotiating terms once a deal is closed. So once you've signed and the project finance deal is legally binding with little room for renegotiation. So changes in law, technical issues may not easily be accommodated. And there's limited flexibility compared to corporate finance. So in corporate finance, funds can be reallocated across projects, but in project finance, funds are there's a term called ring fenced. Okay, meaning they are for a specific project. You can't adulterate them. So this structure has this rigidity, which complicates what? This project scope. So what are the benefits that project finance has to a host country? So a host country, especially in developing countries, can gain a number of economic and social and technical benefits through project finance infrastructure. So number one, access to foreign technology and expertise. So project finance will bring in the world-class engineers, management, and operational systems. So countries will benefit from the technology transfer and global best practices. Two, job creation and skill. We know what these Kyoto Kukaraji we have done. So large finance infrastructure create direct jobs to the host countries, indirect employment. Then improvement in infrastructure with limited fiscal pressure. So governments will avoid upfront public expenditure by involving private partners through the PPPs. So this will allow infrastructure development without ballooning public debt. So indirectly, they'll redirect the funds that were meant for certain projects in the economy to its intended purposes. It also enhances the credit worth and investor confidence. So successful projects will demonstrate governance capability and investment readiness. So to encourage future FDI. So once a project is successful, more projects will come. Transparent process. So regulatory reforms, bankable frameworks will enhance the country's investment profile. Then tax revenue from projects. So projects will contribute also to government's revenue through these corporate taxes, VAT, duty, and these revenues will support the national development on a broader fiscal scalability. So these are some of the benefits we look at. So with this being said, I expect you to answer question number 1. Everything has been covered in our lecture. So I need you to take time to go through question number 1. I'll ask in my next class randomly. Thank you so much for your time. Unless there are any questions.